Fantastic. Thank you very much for turning that on. Just double checking that everyone can hear me, and then we'll get going. Also, just want to update you very, very quickly on the German ZEW, which was much stronger than expected. A very, very good German ZEW there. Let me just put that up 1 second. Bear with me. I'm just tweeting. 48.2 for Feb. Up from 31.5 in Jan. That is fantastic, and the Euro's popped higher on that. It's good news. Great. Well, yeah, that is the. That is very good data, and is yet again adding to that good news that is coming from Germany. I just want to do a tiny bit of analysis on this, and then just to share with you guys so that we used to this. That is the highest level since mid-2010, so good news there. Let's get to sharing a desktop, shall we, so you guys can see something. Right, looks like we're all okay. There you go. This is Euro. This is the hourly chart. As you can see, that pop higher above 133.60 is, which is the 100-day moving average. That's on the back of what we've seen now. So on the back of that ZEW, what we've seen in Euro, overall in the markets, obviously, it's been a very quiet start to the week because the US was on holiday yesterday. But what we have seen is fairly directionless markets. It looks like we're waiting for something. Some themes are developing, though, very nicely, which is the weak euro and also the weak pound. Much weaker pound, actually. Nothing seems to be able to stop that. Euro's obviously had been stuck around that 33.50 mark. We have pushed higher now on the back of this ZEW. Now we think that could potentially help the euro in the short term. But the market will very much be focused on the PMI data that comes out on Thursday, because that's for the whole Eurozone. Remember, this is for Germany, ZEW really. We will be looking for things like what's going on in Spain, what's going on in Italy, etc., etc. And just adding to that, not only have we got quite a lot of economic news, but this Euro is going to have Euro prices. They're going to have to battle between what's coming out of the Euro economy, so the economic data, which has been fairly good. There's expectations that we'll see a further increase or pick up in the PMI, and you've got to balance that against these election risks. Mainly now coming from Italy. Cyprus had elections at the weekend, or the first round of elections. The pro-austerity, pro-reform guy won, which opens the way then for Cyprus to get a bailout. He is running again in a second round, but he's expected to win that hands down. So that really does leave the way open for Italy. And in fact, I would say the outcome of the Italian elections are really unknown. Who would have thought a year ago or 6 months ago that Berlusconi would still be in the running? Now, he is expected to come second, which would be good news because it would mean Bassani would win. And he could essentially set up a coalition with Monti. That's considered the best thing. But Berlusconi could be in the lead. There's a poll blackout. So there's an awful lot of unknowns there regarding that, and that is key. Now, what I do want to show you though is this. This is the daily chart, and just some levels really, just to get yourself kind of aware with. As we said, haven't really been able to make much headway above that kind of 133.50 level. We still think the kind of 130 kind of 280 to 135 could be the medium-term range. And as you can see, this is when, do you remember that high? That was when Draghi at the beginning of this month spoke out and actually said that he didn't think it was kind of his view that there was it was his view that there would be it was his view that there would be that the euro could potentially be damaging for inflation, cause deflation, which would then cause the central bank to be more accommodative. That was his comments there. And since then, we haven't been able to see the euro recover in any meaningful way. Likewise, Draghi spoke yesterday. It's trading in a very tight range, 130, as I said, 133.50-ish obviously just had that bit of upside now. 132.80 to 50, or 132.50 to 80, I should say, is the next kind of support zone that we're looking at. But I also just want to draw something for you. So from this kind of July low, let's take a look there. Here we go, yeah. This 130, so this is 132.80, that's a really key level. And then once we go below here, we're kind of 131.5. There's an awful lot of support down here, but I think that if we get below this 132.80 level, it does kind of negate, particularly that, let me just bring that down just a smidge. Oh, caused a bit of a desire here, because I actually don't think it's 132.70. I'm just going to try and bring it down a little bit. Hang on. Or try and get it more closer to the close. Right, yeah, there we go. Right, it's here. So it's this kind of 132.205 level. It's the uptrend dating back to kind of July, so 7 months now. This is, if we get below there, we think it negates the uptrend and could see a sharp decline back towards that 130 mark. What is there that could kind of propel it higher? We don't necessarily think that the euro is going to fall through the floor. The main reason why is that they're not embarking on central bank easing. We do think that there's a risk of another flare-up in the sovereign debt crisis, which could lead to a spike in bonds, euro to come down. However, we do think that downside will be fairly limited, and maybe below 130 isn't going to be isn't necessarily around the corner. The other thing that we would point out as well is that every time the ECB comes in to try and bring down bond yields, it causes the euro to rally. So what you're seeing is, efforts that they've taken so far really have been or to save the eurozone and expand their balance sheet in the eurozone. That's actually helped to boost the euro. That's not necessarily the case elsewhere, but it is, because at the end of the day, credit risk does have an impact on the currency. So if we do see kind of maybe a problem with Italy this week, and we see the activation of the OMT program in the coming months, that could be euro positive. That's what it's been in the past. Obviously, usually expanding your balance sheet should be euro negative, but that's not been the case. Both expansion and contraction of the balance sheet has been both euro negative. If anything, we could see, if anything, we could see continual contraction of the balance sheet in the eurozone could end up actually being euro negative, largely because it could thwart growth. It could make it harder for these peripheral economies to recover. So hopefully that makes some sense. It's a bit technical. Very good point. Mark C has just said, can I say a few words about bond yields versus forex? What needs to be understood? That's a really good point. Basically, peripheral bond yields tend to have an inverse correlation with the euro, and I'm going to show you that now. I'm going to actually put it on a chart. Bear with me one moment. That is a very good point. So basically, rising credit risk, so bond yields measure credit risk. When bond yields rise, it means credit risk is rising. That should be negative for a currency. Because deteriorating credit risk should be currency negative, right? That makes sense, I think. GBT. Right, let me bring this chart over here. And here you see it perfectly. This is the white line is euro dollar, and the orange line is GBT, so that is Italian 10-year bond yields. As you can see, as Italian 10-year bond yields have fallen very, very sharply, that coincided, so at the peak in Italian bond yields coincided with the low in the euro, and since Italian bond yields have been moderating, so too has the euro been gaining strength. One thing that we would say though, however, there is a risk of a big pop higher in these Italian bond yields, because for us the market is really underpricing the risk of these Italian elections and potentially of an adverse outcome for austerity, reform, economic reform, etc. And that could weigh if this relationship holds, then that would weigh very heavily on the euro, one would say, to potentially get back below 130. Now, does that answer your question? Does that help you understand? I think, you can go into great detail, but I think the one key thing is that when bond yields rise in Italy and Spain, that's bad news for the euro. So that's the easy, simple way to understand it, and that seems to be the case. Now, usually rising bond yields can be currency positive, but not when it means that credit risk is on the rise, if you see what I mean. And I'm just going to show you something else on that line. Now, just bear with me one moment, because this really feeds into what we're talking about the pound as well. Just bear with me one moment while I pull this up. This is the UK. So what do we know about the UK at the moment? We know that the UK has been in it's got weak growth. There are concerns about us and our credit rating. There is also concerns about, the other thing that's like not supporting the pound at the moment is that we were a safe haven really during times of Eurozone trouble. So when the Eurozone is stabilising, that should be pound negative. In fact, it is. Since kind of November, December, we've really seen the pound decline quite sharply. So what we've seen here, or what we are seeing here, the white line, what this chart means is the white line is sterling, so it's sterling dollar, so it's the cable rate, otherwise known as cable. The orange line here is the 10-year UK bond yield, so the 10-year gilt yield. Rising gilt yields are also bad news for the pound. Now, some people may say, well, hang on a minute, rising bond yields should be good news for the pound. It depends why they're rising. So what we've seen is rising treasury yields has been fairly supportive to things like dollar yen, and I'll show you that in a moment, because rising treasury yields in the US show growth to be on a more healthy footing or a more stable footing. That's good news for the dollar, especially against the yen, because growth there is weak. But in the UK, we're seeing bond yields rise slightly because our credit risk is rising. That is bad news. Likewise, with what I was showing you before regarding Europe and Italy, regarding Europe and Italy, the euro and Italy, sorry. So when Italian credit risk rise, that's negative for the euro. Likewise, when UK credit risk rise, that's negative for the pound. So is this move higher in gilt yields? Is that potentially preempting? Is that pricing in? Have we priced in already our AAA credit rating being cut here in the UK? Potentially, yes. I'm sorry, I know I'm saying ours and this, that and the other. I know not all of you are from the UK, so do forgive me on that level. So it's been it's an interesting one. This is, let's take a closer look at the pound here. Again, I mean, the pound has really slipped under the radar of the G20, which has been fascinating. It really has been fascinating, largely because what we've seen is the UK, the economy is so weak. We haven't seen the central bank actually do anything, especially not regarding. We haven't seen the central bank do anything, especially not regarding. Especially not regarding more QE, etc. So thus, what can the G20 say to them? But it has been interesting because the Bank of England have been quite vocal, actually, about how useful or how worrisome a strong pound is. So a weaker pound is useful for the UK economy. They've been able to say that with free rein, whereas Japan has been really reined in. So that, again, is another pound negative. It seems like the UK is being able to slip under that currency wars radar, even though it is the second worst performing currency in the G10 since the start of the year. Now, if you just look here, below 154, so we fell to a 7-month low yesterday, and that was on those BOE comments from Martin Wheel about the pound specifically. So again, we're kind of below there. We are consolidating a little bit now, around about that 155 level, which suggests that that's potentially a low for now. With let's just get up the RSI here. 1 second. Yeah, moving slightly towards oversold territory, so it would be quite normal to take a bit of a breather here. Let's take a look at the shorter term chart. So as you can see, real nice slow decline there, which is this type of chart. Let me just move this. Remove current study. This kind of slow decline here is real testament to a downtrend, and suggests to us that there could be further to go. once we get below kind of 154.60, we've then got to go back to the daily chart, and that really opens the way, I think, to all the way back down to kind of those 152.80 levels, which is the low from June 2012. That's now a massive, let me just change this quickly, a huge resistance level. So that comes in about 152, about 152.75-ish. Sorry, that's a massive support level now on the downside. So really important to kind of keep that in mind with the pound, that we believe any strength will actually be sold into, especially a move back towards that kind of, at the moment, 155.20 looks a bit like a double top up here, if you can just see it there, and then above that we're kind of moving towards 155.75, 156. The other thing, just bear with me one moment. I'm just pulling up sorry, I was just pulling up another chart just to show you kind of the level, show you just where we are now and just how in a downtrend we are. Let's take a quick look at this. This is the weekly Ichimoku cloud. So those of you who followed me for a long time will know I'm quite a fan of the old Ichimoku, and the reason why is because I find it very, very simple. I don't use too much, I don't look at it in too complicated a way. I think the benefit of the Ichimoku is that it's quite clear. In last week, we had such a sharp decline that we got through the bottom of the weekly Ichimoku cloud. So most of you may know, daily, whatever. The break below the weekly is significant. The last time we did that was June, was mid-2012, which does open the way for this kind of sharper decline lower to this 153 level, which would be the lowest level in a year. And then below there, I mean, we're looking back to kind of those 145 lows from June 2010. So kind of 2.5-year lows. This is significant. These are big moves. If this is a downtrend, there are a few reasons why this could be a downtrend. Obviously, what we've seen is CFTC data. I know those of you who have joined me before and who let me just... here we go. Those of you who've joined me before and joined me at kind of different conferences and things, I do like to look at kind of, the sentiment in the market. You can have kind of gut feeling why you think the pound can go lower. The Bank of England can want it to go lower. The government can want it to go lower. But at the end of the day, it's what the market thinks, because we are a market-based exchange rate. And this suggests to me we're going lower. This is the Bloomberg IMM data, so it's positioning in the hedge fund community, basically. And last week we swung from net positive to net negative. So there could be further to go on the downside. We're not that deep into negative territory. So really, the decline that we've seen to kind of below 155 was very much longs actually getting out. This is where we get the real people turning very bearish on it. So if we're going to see that decline to 153, maybe even below there, maybe even back to kind of 150, 148. We're going to see this extend. So I would say look at this very, very closely. What are the near-term drivers of the pound? Well, as we said, obviously, there is economic data. There is quite a lot coming out on Wednesday. And in terms of near-term drivers, we've got the Bank of England minutes. We've also got the labour market data. Labour market data has been quite difficult to read and difficult to place in this kind of economic tapestry of the UK, because the labour market data has been doing very well. So we've seen the unemployment rate remain fairly okay, 7.7%. The number of jobless has been falling, and the jobs created has been really, really good. The other thing that we would point out as well is that we have also seen some key moves, combined with that, not only have we seen kind of bond yields rise, that's been currency negative, but we've also seen kind of the Bank of England, as I mentioned before, actually mention the pound. So if they do that again in the minutes, that could actually trump even better. That could trump potentially unemployment data, depending on how good that is. But if we do get good unemployment data versus dovish minutes, then expect a lot of volatility in the pound. So, but we do think that any strength will be sold into. So any move back towards 156. Would be used to kind of sell the pound at a better level, because now I think the market is really saying, hang on a minute, this is our funding currency of choice. With the yen, people may think, hang on a minute, we've missed it, we've lost it. With the pound, it could be a different story. Let's just bring that pound up here again, because I'll show you that here. 1 second. Oh, I did put. Bear with me. Sorry. Just want to show you kind of relative stances. So this is from the start of the year. We've fallen like 5% in cable. Let's take a look at Japanese yen. You know, since November, I know it's a longer time frame, but the dollar yen has appreciated by 20%. So there is further downside, I think, for the pound, or some people could be seeing that maybe actually as funding currency, maybe the yen isn't the best choice right now because it might just go a little bit sticky from here because of G20 pressure, the fact the Fed is doing more, is continuing with its QE program, etc. Whereas with the pound, there could actually be more downside. So you know, it doesn't look extended to the downside in any way. And in fact, we will look at that here. This is the daily chart. As you can see, this is RSI, which looks at oversold, overbought conditions. Not quite in oversold territory yet. Likewise on the weekly, you know, firmly pointed lower, but not quite, again, not quite in oversold territory just yet. But the closer we get to that 30 mark in the RSI, which is supposed to indicate oversold levels, we could see a bit of a pullback. So going back to kind of that daily chart, I'm going to get rid of some of these lines. They're a bit annoying. Sorry. As you can see, you know, any kind of pullback towards that 156 area could really be used as a buying zone. Let's also, of course, as I said, let's take a quick look at dollar yen. That still is, you know, people are liking it. They still see further upside. I agree. But we are more incremental. It's more about the incremental steps rather than it's more about the incremental steps rather than the full-blown, you know, another kind of huge rally from kind of 77 all the way up to kind of 90 or 95. We see it as 95 being kind of the path to 95 being littered with hurdles that could trip you up. Likewise, the path to 100. Obviously, the double top is there in place, kind of 94.70. We've rejected 94.20 yesterday and just been pulled back lower. Again, it's because it's been, or the key driver of that was Bank of Japan minutes on one hand saying that, you know, yes, they've adopted an inflation target, but it's more of a long-term thing rather than a mad rush to weaken the yen and cause inflation to rise. The other thing is, of course, was that we had kind of differing views from the Prime Minister, who was like, yeah, we're going to weaken the yen massively, and the much more temperate Finance Minister, who's probably being pressured massively by what's been going on in after the G20. We also think that there's also a bit of a kind of a longer term issue there with the new governor being appointed. So there's now a bit of risk going on that, well, maybe they won't go as maybe they won't end up being as dovish as expected. Well, it's all relative. He's going to be dovish, I'd say, regardless. So anyway, that's just one thing that's kind of weighed on this. We see it as trading in a bit of a range with 92.70 on the downside, and again, as I mentioned, 94.70 on the upside. So 200 pip range, certainly just until kind of the dust settles, maybe the G20 goes away, and the new governor and maybe kind of the new governor comes on board. The other thing that we would say is this 92.20 level, the 21-day moving average, is a really, really, really key support level, because if we get below there, if we get below the 21-day moving average, that really negates a little bit of this uptrend, and we could see a further pullback, maybe back towards that 85 mark. That is important, and does suggest to us that you know, if we were to get back down there and it doesn't hold a support, then it could be a bit of game over for the dollar yen trade. Well, what does that mean? Well, that could actually be worse for the pound, because the market does need a funding currency, that is for sure. Are there any questions at this stage? I think it's also worth looking at the Aussie. It always is, huh? But the RBA actually weren't as dovish as expected today, which meant that we kind of got above this back above kind of 103 level after having dipped below there earlier and then towards the end of last week. But still, we've still got this huge hurdle to get over, which is 103.80. We actually think that any strength, maybe a move towards 104, even though kind of if, you know, a move towards 104 would probably be sold into. So, someone just said, Marksy, what isn't the new funding currency? That's the safe haven currency. Well, Well, Japan has in the past actually been a funding currency during periods of stabilization. So that's what I meant when I said Japan, the yen in the past has been a funding currency. This is kind of pre-2008. It was the very famous carry trade. It's what you used as your funding currency for the carry trade. That obviously hasn't been the case. Obviously, we have kind of been rallying since then. And instead, what we've seen is the pound really take that mantle. Yields aren't going anywhere fast. Economy's weak. Got high debt levels. That all suggests a weak currency. These are long-term themes as well in the UK. So that's why for us the pound is going to be weaker. So what we've seen is that the yen actually just in the last kind of 6 months or no 3-4 months really become a funding currency of choice, because obviously this move higher in dollar yen is when yen is weakening and the dollar's getting stronger. So the yen has been sold off. But at the same time, we'll look at the pound. The pound has also been sold, obviously going the other way because it's pound dollar, but not to the same extent. So that's what I mean when I said, like, if the dollar weak dollar trend starts to stall for whatever reason, then we could see further declines in cable. Maybe what you're saying is that would be because of some sort of external event which could trigger yen's safe haven status. I think that's true. I do think it'll be quite interesting actually the next round of major trouble in the economy, or major kind of risk averse event in the economy, largely because in our view that would make the yen will then be tested. Have we lost that relationship? Has it lost its safe haven status? There's a lot of reason now to suggest that maybe it has, obviously because of what the government's been doing, political interference, the BOJ, is the BOJ independent, etc., etc. Does that erode the yen's safe haven status? Well, that hasn't been tested yet, but that's an interesting theme, Mark. Well done on. That's a good question to bring up. As I mentioned, let's go back to Aussie, because again there's this huge resistance level here. People may say, well, hang on a minute, those RBA minutes, they weren't nearly as dovish as some expected. However, where we're concerned with the Aussie dollar is a more long-term concern. That the mining industry has been a key driver of Aussie growth for many years. What we're seeing now instead is the potentially no more rate cuts, or not for the near term anyway, and the RBA chilling, really sitting there like really waiting, just enjoying the stabilisation in the overall environment, the pickup in China, etc., etc. However, we do think that gains in Aussie dollar are capped. Obviously, this has been the long-term range with 106 at the top. This is the near-term support level, so a cluster of daily moving averages, massive, between kind of 104 and 104.20. If we did get over there, we may make a stab at 105, but we think eventually the sellers will definitely come in. We don't see us going to 110 anytime soon. Number one, there's a lot of external risks, and Aussie will be sensitive to that. Number two, the Aussie will also be at risk, we think, from kind of an end to the mining boom, concerns that the domestic economy isn't strong enough to pick up the slack, which will eventually lead to further rate cuts from the RBA. So again, watch out for that 103.80 to 104.20 on the upside, and on the downside 102.80 looks like kind of a bit of a double bottom there. That's where we saw kind of a good reversal yesterday and the week before. Someone's just said Euro Aussie. I'll happily look at that. Euro Aussie's been quite interesting. We've had a good recovery, and then just in the last kind of week or so, as the Aussie has picked up, then we've seen kind of us dip below this 130 level, which was always going to be quite keen support. One thing we would say as well is that the RSI is pointing, we 130 right now look like, or above 130 towards 132, really look like we were in overbought territory. So that's where the market's coming in and selling. In terms of where they might buy again, well, 126.15 looks like a good area, as does kind of 127.5. On a more shorter term basis though, we are starting to move into quite oversold territory. So we may see a pullback, maybe towards that 129.50 mark, 129.75, before before we see another dip to the downside, because we do think that kind of, euro, obviously the Aussie, the outlook for the Aussie isn't necessarily fantastic either. But if we continue to see stabilisation in the global economy, we should see the Aussie actually outperform the euro. And the reason why is that number one, it's got quite a strong, relatively speaking, some of its economy is stronger than some of the weakest economies in Europe. It's not nearly as strong as Germany, though. Likewise, greater stabilisation, better news for their terms of trade, etc., etc. Good news for China, whatever. That should boost the Aussie. So stabilisation, continued signs of good growth should be good news. Bad news for Euro Aussie, good news for the Aussie. So we could, as we said, obviously we've gone through the 21-day moving average here on a more shorter-term basis. We may see a bit of a pullback to 129.50, but that could be used as a selling opportunity to get back below kind of 128.50 in the very short term, and then back towards this kind of 127 mark, 55-day moving average. Okay, are there any other questions? Because it is 10:30. Ahead today, we do have, there is just one other thing I want to show you, which is gold. Let's just look at that. A lot of people have been asking about gold. I know our clients are very interested in it. To us, we see gold in the medium to long term actually dropping lower and maybe getting to this 1550, 1530 low from May. That would probably be over the next kind of 3 to 4 months because obviously the market is stabilizing, global growth is stabilizing, yet there's no sign of inflation. So in that sense, why do you need gold? They're kind of the key reasons for us. Obviously on the upside, you've got this 1650 level acting as massive support just ahead of this cluster of daily moving averages. So between kind of 1650, 1670, it's been a really sticky zone. That's kind of been the range that we're in, but it does look like that kind of break convincingly below 1650 has really disrupted the range here, so we think any pullback probably be short-lived, and actually a decline towards that 1530 level is probably on the cards. Again, the RSI is suggesting that we were a little bit oversold at 1600, which suggests we may have a bit of a pullback, maybe towards 1630, 1640 in the short term before kind of turning around and it being sold off. But we definitely do see a further decline. Someone just said, what is your trigger decision to enter? And is that a trigger decision to enter into gold? Well, for us it would be a move back towards kind of 1640. I would sell on any move towards there, largely because I do believe that we are headed lower, because I just don't think the buying interest is there for gold. Let's also just take a quick look at the CFTC data. Let's bear with me one moment. This is commercial interest in gold. As you can see here, it's really, really fallen. I mean, it's still, people aren't net short of gold. They're still in positive territory, but they are really cutting back. And that's the problem with gold, right? There's not enough buyers out there at the moment. And I don't see that changing, because I don't think gold's not got any drivers at the moment. It didn't rally when there was severe stress in the Eurozone. Likewise, it's not rallying now. There's a bit of economic recovery going on around the world. So to me, it's lacking of drivers, lacking of interest, and that could see us drift lower to 1550. So a move higher back towards kind of 1650, or a decisive move below 1600, like a daily close or a weekly close below 1600, and I would enter it. So they're my trigger levels that I would talk about. Aussie Kiwi, let's take a quick look at that. In Aussie Kiwi again, it really has declined, because the Kiwi, remember, has been doing fairly well economically and outpacing some of the economic data points from Australia, which has been quite positive. But we have found a base here below 122 at 121.60, which looks like a double bottom. We are seeing, just go through one moment. We have seen a bit of a recovery. It's been quite a powerful recovery. Likewise, let's just bring up the MACD. The MACD looks like it's turning. The RSI has turned already, which suggests that below 121, that was where the market came in, and that was where they were really willing to push it higher. Someone just said spangly stuff. I'm assuming they're good gold bugs, that Russian Chinese central banks are buying gold like crazy. India is having to flatten interest rates by raising taxes. There's loads of interest in buying gold. It's just not being managed down by government entities. I think there's merit in your point for sure. The World Gold Council came out. They said that central banks are buying gold. You know, it's been a record year for gold buying from central banks. India, I disagree with your point actually, because I don't necessarily think it's taxes that are flattening that. India is a big consumer of gold for jewellery purposes, and around about, you know, it's looked too strong for them. It's been too expensive, so it's dropped. People have then gone to use other things instead of gold. So I do worry. I think, you know, until we get to kind of a more decent level, maybe kind of below that 1500 level, that's when the Indian buyers might come in, but they haven't quite adjusted to the higher level yet. You know, India is obviously an economy going through many changes, and that's kind of the key thing. It's just being managed down by government entities, but some government entities are obviously managing it down. Others are really grabbing hold of it, like the Bundesbank is really into it. So again, I don't see gold falling off a cliff. I think that it will probably moderate, but you know, I don't see a long-term decline. You know, I don't see us going back to like below $1,000 or $200 or something. You know, I just think that right now, I think in the cycle, it's not good for gold, and I think it's probably going to take a few months for gold to pick up again. What do I normally see in RSI and MACD as clues? Well, the RSI that's really used for when things are oversold and overbought. They're both momentum indicators, so it's kind of the momentum of the market. I wouldn't necessarily use them just to trade on, but they are quite useful just to show kind of, you know, well, where is the feelings of the market. I also like to look at other things like the CFTC data. It gives me a bit more realism there. The MACD, again, kind of more momentum. It just kind of shows you if momentum is on the upside or the downside. Obviously, when the pink line crosses the blue line, that is a bullish signal. Likewise, kind of, you know, we've bounced from kind of these oversold levels below 120.22 in Aussie Kiwi, and the RSI is telling us kind of a good thing. When MACDs become really important or when they become very useful is when they start to show, usually towards maybe the end of a trend potentially, they might start to show a bit of pulling off, or they might diverge from price action. That's when they're really useful. Someone's just said, spangly stuff, like your name, looking for a pull back lower to 1475 to 1430. I mean, exactly, we're kind of on the same page here, I think. I would even say 1530, so those lows from April last year. But guys, I've run totally over time. Thank you all. Brilliant questions as ever. I hope you did manage to vote for the Forex Best Awards at FX Street. We were nominated. We are hoping, well, our fingers are crossed anyway, but we do know we were up against some very good competition. So it was just nice, even lovely just to be nominated there. But the more important thing, of course, is that you guys came today. Hopefully you learned something. Your questions were fantastic. It was great to have you on board. Please do join us next week for more. Thank you.